Okay, so for Chapter 7 deals with deduction and losses mainly with regards to businesses. However, there are some losses that we will talk about and touch on that can be personal losses that will show up. And when we deal with personal losses, they're mainly going to deal with capital gains. There are some things that we are going to talk about that aren't very common anymore because of changes that were made with the tax law. At the end of what we're going to talk about, there are some things that are not very clear, and net operating losses are what we're going to talk about at the very end. And I'm going to give you a couple problems in the book, depending on how far we get, that I suggest you look at before you try doing your homework. And the reason is because when you look at them in the book, there's answers, right? And you can walk through and look at them. Then when you go to do your homework, you've already looked at ones with answers in it instead of trial and error with the homework first, all right? Net operating loss is not the easiest thing because we have to look at whether things are a total loss or not a total loss, and then we can carry it back and we can carry it forward. So there's a couple different things going on. So in this big picture, there are lots of things going on. So I just want to briefly mention them because we will come back. This woman had a really, really bad year, okay? It cracks me up. Okay, so Janice's friend, she loaned her friend Janice $25,000. Janice made a few scheduled payments of $7,000 when Janice unexpectedly died. All right, then last October, Martha invested $50,000 in a pharmaceutical company that had been profitable. They had a patent infringement case, and they went bankrupt. All right, so Martha lost money there. Martha had owned a bookstore where she was a sole proprietorship. The bookstore had been making $75,000 a year, and this year, because of online book growth, she lost $180,000. And in September, a hurricane went through and blew a huge oak tree over onto her house, causing $32,000 worth of damage, of which she only received a check for $25,000. And finally, Martha purchased $20,000 of what she thought was Section 1244 stock. Unfortunately, it began to decline, and she sold it for only $12,000. So, positive note, Martha had a lot of money to do investing, all right, but Martha didn't make very good choices, and her bookstore fell apart. So, we have bad debt. Just like if those of you that took financial accounting, businesses have bad debt, all right? Bad debt in financial accounting, you get to write off. It's an expense. It helps you reduce net income, all right? Here we're looking at it from a tax purposes. So bad debt is permitted only if you have income arising from it. You can't write off bad debt for tax purposes if you didn't have income arising from it. And no deduction is allowed for taxpayers who are on a cash basis, which is a lot of the taxpayers that we're talking about. So,
income arising from bad debt, you mean some people are paying it off?
No, meaning the bad debt arose from something that was generating income.
When you were, okay.
That you're generating income. So Martha is a cash-based taxpayer, okay? She cannot take a bad debt deduction for unpaid accrued interest on Janice's loan because the loan that she made Janice didn't generate any income. She never got any of that interest, okay? And she was cash-based. All right, now some business bad debt, there's specific charge-off methods that you have to use when you're going through it. All right, you deduct as an ordinary loss in the year in which it either partially or wholly became worthless, the bad debt. You can't decide to drag it out over several different years. If a business previously deducted bad debt and then you collect it, you then have to record that debt as income. So you've heard me say this totally before, and I know this isn't on here, but you've heard me say this before. If you think you're going to collect something in the future, don't deduct it or write it off. It still stays the same. Deduction or write it off. Now it says if a business bad debt previously deducted becomes totally worthless in the future, you can only deduct now what's left of what you didn't deduct before. Right? Which kind of seems common sense, but okay.
If you think you're going to get paid for it, and then a year goes by, and then another year goes by, and
then you will deduct it as worthless. Okay. Right. Yep. Okay. In the case of total worthlessness, deduction is allowed for the entire amount in the year in which it becomes total worthlessness. So, James, in your case, you thought you were going to collect it, you thought you were going to collect it, you thought you were going to collect it, and then you don't, and you realize it's worthless, you just write it off as worthless. But again, business bad debt, and you can't be a cash-based collector. All right. If it arises from sale of services or products, then it's going to be the face value of what you're selling. If it arises from purchase bad debt, it's going to be amount equal to the amount that you purchased the instrument for. So that's going to be like the stock or bonds or something that you purchased. And if a receivable, I already said this, had been written off and then you decide to collect it, then you have to record it as income. Now, non-business bad debt is what you're going to find out is a lot of our bad debt, okay? That is bad debt arising from a non-business transaction, right? So, not debt related, to our business. And it's usually going to be a short-term capital loss, which you're going to find out is not the type of loss that we want. We want long-term capital losses, all right? And no deduction is allowed for partial worthlessness. So if we go back to, nope, not yet. All right. Related parties, okay. Related party transactions are hard. Now, I've mentioned this already in one of our things. Related party is going to be somebody that, number one, you're related to, or someone that you cannot provide what they call arm's length transaction, a distance between you and them. So regulations say that when you have a debt-debtor relationship, they're going to look into that transaction. So you cannot write off a bad debt between related party transactions. So it's not that you can't do it, but individual cases are going to be examined if they believe there are related party transactions. So it could be deductible, it could not be deductible. All right, individuals will generally have non-business bad debt unless you're in the business of loaning money. All right, that's pretty easy to decide. Or it's associated with a business or trade, a business. All right, determination is made at the time the debt is created or when it becomes worthless. So if we go back to our big picture, when she lent her friend Janice money, she lent her friend Janice money to start a business. Martha wasn't starting the business, and Martha wasn't in the business of lending money, though she made a lot of money. She dealt out a lot of money in that year. That wasn't her business. So it will be a non-business bad debt. All right? All right? Even though the proceeds were used, that is not what she was doing. All right, so a loss on worthless securities. So worthless securities are going to be deductible in the year that they become worthless. All right, those are capital losses deemed to have occurred in the last day in the year in which they become worthless. All right, so it doesn't matter when they become worthless, it's deemed loss on the last day of that year, so December 31st. All right, capital losses may be limited to $3,000. Now, we haven't gotten to this point yet, but does anybody know what I mean by limited? Capital losses are limited to $3,000. No? No?
Use $10,000, you can only deduct $3,000 of it?
Right. So typically, capital losses, without this involved, in the typical sense, when we're not talking about businesses and everything else, is if you own stock, we're going to go with that route, and you sell your stock, but you lost money, right? You bought the stock at $10,000 and you sold the stock for $5,000. You lost $5,000. You can only put up to a $3,000 loss on your taxes. Now, bear with me when I say this. Now, if you also, and people do this on purpose, if you have $30,000 in one stock and you sell that stock for $40,000, you have a $10,000 gain, right? Now, you might turn around and invest it in something else, so it doesn't mean you're taking the cash, but you have a $10,000 gain. You have another stock that you bought at $10,000 that you just sold for $5,000. You have a $5,000 loss. And then you have another stock that you bought at $20,000 that you sold at $10,000. So you have a $10,000 loss. In the end, you have a $5,000 loss. Okay? Now, if you cashed out your money, you got $10,000, $5,000, $10,000. You got $25,000. So, but you technically had a $5,000 loss, right? On your tax,
Like a 50, oh no, you're right, never mind.
on your tax return, you can only show up to a $3,000 loss because it's a personal loss, but you can carry over the other $2,000. So next year you will have a $2,000 loss that you can show. And people actually will go ahead and take a, quote, loss to offset a gain. So they will sell a stock they know is losing money to offset a gain of $10,000 when they're moving stuff around. And they will do that on purpose. I had a friend, I can't tell you exactly why now because it happened so long ago, but he sold a whole bunch of stock. And when he did it, he had huge losses. And I think he just needed to get the money out of those accounts. And he was retired, so he got this money out. Huge amount of losses. We are just now, after 5 years, getting rid of his rollover. Every year he's had $3,000. Now, the first year he did it, it was all loss, but since then he's had a lot of gain. And he's been able to use that loss against his gain to the point that he had $3,000 of a loss. $3,000 of a loss. So he's been able to use the loss to offset his gains every year with a $3,000 loss. And that's nice because on the first page of Schedule 1, that $3,000 loss will offset your taxable income, but only up to. And the reason being, if you think about that, if you could use your total losses to offset your income, you want to talk about a loophole that they're trying to make sure some wealthy people don't use, right? The more money you have, the more you could just sit there every year and be like, I'm selling that, and you'd have no taxable income every year. So that's why you're limited to $3,000, especially in 2008 to 2012 when the market crashed. Nobody would have paid tax. Well, I shouldn't say that. People that had a lot of investments would have not paid taxes, and the people who had no money to invest would have been paying all the taxes. So limited to $3,000 of capital gain losses as a deduction. That's probably the key word. All right, so big picture. Martha owned a pharmaceutical company that cost her $50,000. It became worthless when the company declared bankruptcy. The stock is then worthless, even though May 31st of 2019 is when it was bankrupt. It's actually going to be deemed December 31st. That's the date it became worthless. And then notice it is a long-term capital loss. All right? So when it becomes worthless, it's long-term. And the tax benefits of long-term is always better than short-term. All right, so this concept summary is in your book as well. And what it does is it just kind of goes through the bad debt. So it says, does a valid debt exist? The first question is between the debtor and the creditor. Okay, so if it doesn't, then you can't do it. Is the debt really worthless? Yes. Is the debt evidenced by a security? All right, so there we're talking stocks, bonds, etc. Yes. Okay, now we're dealing with worthless securities. We're done. Is the creditor a corporation? Yes. Bad debt treated as an ordinary deduction? No. Is the debt created or incurred in connection with the creditor's trade or business? Yes. It's a bad debt treated as a short-term capital loss. No, sorry. And if it's yes, it's a bad debt treated as an ordinary deduction. So ordinary deduction, capital loss, ordinary deduction, worthless security. So that's kind of what we're trying to figure out. An ordinary deduction is a business bad debt, and it's going to go off on your business deductions as a 4 AGI. Right? And that is different than putting it as a capital loss, because then it's going to reduce your business income, which is going to help you pay a lot less taxes, because then you're going to be able to go more than the $3,000. All right, so worthless security, Section 1244, results in ordinary loss rather than a capital loss for business. So that is, if we go back, worthless securities, ordinary loss, right here, versus right here. All right, so that's what we're looking at there. So that results in an ordinary loss versus a capital loss. So ordinary losses are a lot different. So if you look at these numbers, worthless securities, you can have up to a $50,000 limit individually and $100,000 if you're married filing jointly. All right. Loss is in excess per year limit is treated as a capital loss. So if you have more than $100,000 if you're married, then it's treated as a capital loss, which is our $3,000 limit per year. Now, In order to have Section 1244 losses that are that high, they're dealt specifically in securities of worthlessness, not in just typical stock, just our regular old stock. All right, so the loss is limited to stock originally owned by the purchaser, all right, who acquired it from the corporation. So this is not me going online and buying stock. This is the original purchase from the corporation. All right, so IPO. All right, original purchase from the original purchase. So I don't know who existed, but when GM went bankrupt, their stock actually went worthless. Ford's did not. All right, Ford went down to like what, $5 or something like that, but GM's went worthless, and then they did a reissue. I don't know who, if anybody, exists that owned GM's original stock, but this would possibly could have existed here of a Section 1244. I don't know. Corporations have to meet some certain requirements for its stocks to qualify. Requirement is limited to $1 million of capital contribution. So no, I just take that back. GM did not qualify. All right, Section 1244 does not apply to gains. It is just losses. So I was trying to get a real life one in there, and then it just zammed me. I couldn't do it. Okay, so here's an example. So Sam purchases $175,000 of stock from XYZ. The outstanding stock is only $800,000, so small value. Sam sells that $175,000 stock for only $90,000, which generated him a loss of $85,000. Sam is single, so Sam gets to have a $50,000 ordinary loss, and then because that exceeds the $50,000 that he's allowed to have, he has a $35,000 long-term capital loss, which means, depending on his income here, he's going to be limited to $3,000 a year. $35,000 for $3,000 a year is going to take a long time, but he could very easily, with a $50,000 loss, he very easily has other capital gains coming in that would offset the $35,000. Okay, so Martha has what she believes is $20,000 of Section 1244. However, and then she sold it for $12,000, generating a loss. However, Martha purchased it from Peter, not from the corporation. So even though she thought it was Section 1244, by her buying it from a third party, it's not. So her section will be a short-term capital loss, and it will follow here. So she still has a loss, but she's going to be limited to the $3,000 a year, not being able to take up to a $50,000, which would allow her to write off the whole $12,000. So you can see, if you're allowed to write off $12,000 versus $3,000, that makes a big difference. So you can see where people are wanting to say, oh, look, it's a capital loss. I've never known anyone to try that, but I'm sure people do. All right, so losses of individuals. So if you're an individual who can deduct losses, you can deduct losses in a trade or business into a transaction that you entered in for profit. So it doesn't have to be a trade or business, but for profit, or fire, storm, or shipwreck. I love the shipwreck, all right, or shipwreck. However, with the new tax laws that went into effect in 2018, those are no longer, you can no longer do those unless you're in a federally declared disaster area. So what does that mean? That means that if you don't have insurance or your insurance doesn't cover your disaster, which is one of the examples we have in here, you do not get a benefit, or you do not get to take the deduction on your taxes anymore unless there's a federally declared disaster area, which unfortunately, this all used to fall under itemized deductions, all right? So, but it wasn't subject to anything except for a $100 floor. So for those individuals that don't have enough life insurance, that don't have enough insurance, or don't have insurance at all, this is a big disadvantage, all right? Unless they happen to be in a declared disaster area. But we all know that if you're hit by a tornado, not a disaster area. If you're hit by a big tornado or an area that had, then it's a disaster area. So it just depends on how big of an area was hurt by whatever happened. All right, so losses or damages to property that arise from this. All right, you have to identify it, sudden impact, unusual in nature, Events are not treated as casual from disease or insect damage. Those are not considered termites, I think, which is interesting, but any type of like locusts or anything like that, that is not considered anything that would fall underneath here. Theft, robbery, larceny, embezzlement is considered theft, so companies can include that, but not misplacing things, which I think is funny that they even include that. But losing something does not count. Casualty is in the year that it occurs, except when the president declares a disaster area, which now has to be the case. And that is because it's the year it occurs, however, the way that the president has come forward is you can go back and amend a tax return, or you can put it in the next year's tax return, depending on how the disaster falls. So it is a little different. And theft is in the year it's discovered. Now, the reason that's a key is because sometimes you don't know when the theft happened until a year or two after, especially in embezzlement. I don't know, we've talked a little bit about it, I think, in this class, how the college had a little embezzlement problem that came out just recently. It's been going on for 10 years, but no one seemed to know about it. Now, when I say college, it is the college, but it's on a branch of the college that isn't like what most of us think about the college. It's workforce development. How it happened, it's driving me bonkers. But I actually sat down with the vice chancellor of finance and said, I have so many questions for you. And his response was, I have so many questions for you. And so I really want to sit down with the state auditor because I have so many questions for them. Because the checks and the money was coming from the state. And supposedly, I'd like to say supposedly, and I'm recording this, so I want to be very careful. We did not realize the money was just coming. Like, we thought we requested the money when needed, but supposedly the state was just funding. So there was a communication issue, so the money was coming to the person that was stealing from us when we weren't necessarily aware that the money was just coming. That's why it was going offshore.
But that makes sense, though.
Yes.
If you don't know.
The college was not aware of the fund. Yeah, so seems like a big state audit issue in my opinion, but I also am not aware of the facts. So I say that with a caveat after it. And I'd love to sit down with whoever that would be on the state side and just ask a whole bunch of audit questions. But I'm sure they're actually being asked a lot of those. So it would be deductible in the year it was discovered. I'd like to see that tax return too. Okay, so how do we, wait a minute, did I skip one?
I have a question though.
Yes, go back.
About what you just said.
Okay.
Of that situation, how much can they write off?
You know, that's a great question because it's my understanding, and I haven't gone back to talk to our vice chancellor. We were able to recover some of that money.
Right, because of the way he did it. But
the
what
way
they
he did.
weren't able to recover the money.
I also believe we have insurance, like most companies do. So my question would be, how much did we recover? How much are we insured? Then it's going to be the difference between those two
Okay.
that we will be able to show as a damage. Now, also you got to remember we're publicly held nonprofit, so that's going to be different than public companies and their write-off.
Oh, okay.
Yeah, which messes with your tax return. All right, so if it's reasonable prospect of full recovery, which goes along with your question, then no loss is permitted. So if we really think that between the theft and insurance we're going to get all of our money back, then it's not even going to go on your tax return. All right. You deduct in the full year any amount that you're not going to be reimbursed. Right. Now you also got to keep in mind that there could be expenses along with this from a lawsuit point of view. I don't know if there is a lawsuit. I honestly don't know if there. I don't know what's going on with it. It's been pretty stinking quiet since it happened. If only partially, you deduct any loss of amounts not covered. All right, the remainder deducted and the claim when it's settled. So once you figure it out. All right, so her residence was damaged. If you remember, $7,000 was the amount that was not covered. She got some insurance back. The president did declare it a national disaster area, so that was positive for her. So she has two options. She can amend her 2018 taxes, which was the year the hurricane hit, or she can go back and or she can put it on her 2019 tax return. All right, so she can do either one of those things. The common person is not going to amend their tax return. Number one, they don't know how, and number two, it costs them too much money. So they're just going to tell the person, if they're paying someone, to put it on this year's because it's cheaper, or they're just going to put it on this year's because that's how they know how to do it. But you can go back and amend. And sometimes it's more financially advantageous to amend. It's just, unfortunately, a lot of the places, and you know from working at H&R Block, it's going to cost you to go back and amend a tax return, even though sometimes it's literally putting the amount in a line. They charge you for it. So how much is the casualty allowed? It's going to be the amount of loss. Its deductible depends on how much of it's non-personal, business or income producing, and is it partial or complete. And I know that sounds really funny, but it really does depend. And personally that does too, just so you guys know that going forward. If your house is partially destroyed by fire or permanently, like 100% destroyed by fire, depends on how you get reimbursed. Same here. So, theft or
Who would make that call?
the insurance company. Now, I don't know if the fire department is part of that from a standpoint, but it's kind of like your car. Who makes the declaration on if your car is totaled? It's what it's going to take to repair it. So when they come and look at your house, can they put it back together again? No, then it's fully done. So it's almost like if they can't put the fire out quickly, let the fire burn it down, which is sad because obviously then you've just lost everything in your house. So theft or complete casualty, the fair market value after equals zero, meaning nothing is left. All right. Adjusted basis of the property less insurance proceeds. So you take whatever is left. Well, the adjusted basis is zero. Okay. If it's a partial casualty, you're going to take the lesser of the decline in the fair market value. So what is it worth now? Or the adjusted basis of the property less the insurance proceeds. All right, so let me give you an example. All right, so we got three different ones. So the first one, we have the adjusted basis is $6,000. The fair market value before was 5, and the fair market value after, 8, and the fair market value after was 5. So the difference is 3. So we had a $3,000 loss. So in that case, our loss will be $3,000 because the adjusted basis before was 6, and the loss is 3. The lesser of them is 3.
What exactly is the adjusted basis?
That's what the value is of the item that was damaged. The adjusted basis of what the value they declare of your property. So for example, of your house, the value of your house is not what you paid for it. The value of your house is what you paid for it plus whatever you put into it. Okay? So that's the adjusted basis. It's not what you could sell it for, and it's not what you paid for it. Okay? So item B, the adjusted basis is $6,000. The before market value is 8, and after it's only worth 1. Well, in this case, you're going to get 6. Okay? So you're going to take the 6. So that's good. Your loss is $6,000. And then the last one, it's a complete loss, so you're going to end up getting the $6,000. And there was no insurance received in any of those. So you didn't have to worry about subtracting it. So you're going to get the lesser of the fair market value, and so in this case, when you subtract, see the loss here was 7, you don't get the 7. You're only going to get the 6. Here the loss was 3, so you can get the 3 because unfortunately for you, it's less than the 6. So you're taking the lesser of the difference between the fair market value and the adjusted basis. And then in the total loss, you just get to take the adjusted basis. So in all those now, that would be your loss. So in all but A, you are getting the adjusted basis loss. You're getting the total loss. All right, non-personal casualty theft. So losses on business, rental, royalty, the deduction is going to be 4 AGI. So when we're looking at 4 AGI, we are looking at Schedule 1. I'm going to bring up the 1040. I have to unfreeze. Because if you look at the 1040, and you look here and you say for AGI, if you remember right, AGI is line 7. There is nothing on there that says to you, wait a minute, where's my losses, right? So that means you know it has to go on Schedule 1. So let's see if I can, I printed all these wonderful forms for us, so let's see if I can find my Schedule 1. I had it last week. It is. It's not. Lots of schedule. There it is. There. All right. All right. So Schedule 1, we have additional income and we have adjustments to income. I'm not saying anything for where we're going to have a. Are we? You see anything? Are we going to add to income? Where do you happen to see business income anywhere?
Number 12.
Line 12. Yes. Because if you look, I'm going to take it back in a second, but I don't want to do it yet. What I had put up there was business, rental, or royalty. And where do business, rental, and royalty come in? They come either Schedule C or Schedule E, which is line 17. So if you have a loss on business, rental, or royalty, it's going to actually be in your Schedule C or your Schedule E. Your loss will actually be in those documents. So it will flow into Schedule 1, which will flow onto a 4 AGI. Okay? If you have losses with non-business rental or royalty, it's going to be from AGI, which will be, I'll put the other form back up. Seriously, it's going to be on your itemized deductions, which is interesting, but it will flow to here, line 8. There's our itemized deductions, and here is your itemized deduction form. I'm going to throw it up here higher. We did not talk about it but there is line 15 that says casualty and theft. Right? That is where it would flow. So 2 things have to happen. 1, it has to be from a federal disaster area that would qualify. And 2, you would actually have to have enough to itemize. So you could get whammy-whammied, right? Because if it doesn't exceed your standard deduction, then you're not going to take it anyway. So you could have a theft, add it to your standard deduction, and it not exceed, you could have a theft, add it with all your itemized other deductions, and not exceed your standard deduction, and then be like, well, that just didn't help me at all. So, catch-22, I guess. I mean, that's one way to look at it. It didn't help you in the sense that you didn't get to use it, but your standard deduction is still more. But sometimes you look at those situations, you think, well, I wish I could deduct it somewhere else, I guess is the way I was looking at it, if you have that type of theft.
On the theft of a security. Can
Yes.
you say again the difference between a security and just a stock?
Well, there isn't necessarily a difference. What it's saying there is that theft of a security has to be a Section 1244 security,
Okay.
which is a certain type of stock.
Okay.
Right? And it's not subject to the 2% limitation that certain miscellaneous itemized deductions, which no longer exist under the new laws until 2025. All right, so depending on property gain, it could be ordinary or it could be capital. It could be ordinary or capital. So what I want to say about that is you could actually have a gain from a theft or a casualty. How would that happen? How could you have a gain from a loss?
If the loss was greater than the actual value?
I think what you're saying, I think what you mean is not what you're saying. If what you got back, what you received from, like, let's say the insurance company actually benefited you more from what the loss was, then you would show a gain. All right? And that can happen. That would be a positive, right? But it can happen. So insurance proceeds less adjusted basis in the property would give you a non-personal gain. All right, so this kind of goes to a little bit more of how you would declare it. casualty for personal property, there's something called a $100 floor, meaning every time you have an event, it has to exceed $100. You have to deduct that off the event. And then it has to exceed 10% of AGI. All right, not 2%, but 10% of AGI. Only if in a federal deduct area, it's not subject to the 2%. Right? And then the amount of personal casualty, less of the decline value, or we already went through that. All right, so as long as you get the value, in our example, it was a 3,000, 6,000, 6,000, but it would have to exceed that 10% of AGI. All right. Insurance proceeds may result in a gain. All right, if they give you more than what it was worth. And how can that happen? Think about how you may or may not insure your house if you own a home. If you insure it for replacement value, depending on what's around you or how things are, you could possibly get a house that's worth more than what your house was. And sometimes you see that. You drive through an older area in Afton, and there's been 2 or 3 houses that have burnt down in 20 years, so I'm not saying recently, by my mother-in-law's house. And you can tell because you drive by these cute little gingerbread brick homes, and there's big 2-story homes that are being put up, and they're not brick anymore, but they're big, pretty frame houses. And they don't match anything else that's around. And basically what happened is they got their insurance proceeds, and instead of a 2-bedroom, 1-bath house, they now have a 4-bedroom, 2-story, because their lots aren't big enough, house to be put up. So you can get a gain. All right, if a taxpayer has both a personal casualty and a theft gain as well as losses, an exception to the rule that disallows a deduction for the personally lost other than those in federally disaster areas. So, to sum this up, if you had a really crappy year and you actually have a loss in a federal disaster area and a gain or loss in a non-federal disaster area, you can use that loss that typically wouldn't be deductible to offset a loss that or gain that is deductible. So the easiest way without showing you all this is I believe my next slide shows you an example. Okay? So let me show you. I had a personal gain of $2,500, and this is after all of the $100 floors, okay, and 10%. So even after I have a $50,000 AGI, I had a $2,500 personal gain. I had a $2,000 loss from a non-federal declared disaster area, and I had a $9,000 loss from a federally declared disaster area. So I can take my gain and use my non-federal disaster area to offset that gain. All right? Because it's a personal gain. Personal gains have to be declared on your taxes. Not your losses, but your gains. So I can offset my personal loss against my personal gain. Now I have a $500 personal gain. Then I can take my $500 personal gain and use that against my true casualty loss, and now I have a $8,500 casualty loss that I can use, and then that has to exceed my $50,000 by 10% and my $100 floor. So in the end, I already used my $100 floor, my 10%. So in the end, I have $3,500 itemized deduction and no gain. So in getting at that, I can use, and the thing is, take your non-deductible loss against your gain first, leaving your deductible loss for the end. Now, I don't know how many people have all those different things that combine, but obviously it's enough that it got referenced in the book. It's just not the people I deal with on a regular basis. But it exists enough that it's referenced, right? So these things happen. Okay, the next couple slides I am going to skip through. CPA people,